Hi, my name is Sergey Savastyuk, and today I'm going to talk about what to expect from stock market. It's after the Liberation Day, April 2nd, 2025. Today is April 3rd, 2025. Okay, so that's going to be quite interesting. Please listen to the end. You're going to find out a lot of interesting things about the markets and how we work with these heavy market conditions. Okay, so you can find our legal information on our website, and here is the agenda for today's presentation. I will talk about the stock market uncertainty. I will talk about the valuation comparing with the dot-com bubble. Then I will do technical analysis for S&P 500. Then discuss how to determine the chances of recession. Then what to expect from market in 2025. And then where to look at the leading indicators. It is going to be kind of interesting from my perspective. And then I will talk about AI bubble of 2023, 2024, and now I think it is bursting. I'm not sure that the people use this term like it was dot-com bubble and internet bubble, but this is the AI bubble. I think is bursting right now. Okay. And at the end, I'm going to make a case for trading versus investing for at least 2025. Okay, let's start from the Liberation Day, and what we see that the reciprocal tariffs, which were raised yesterday, actually go beyond the last century. It go to more than 100 years. And as you can see, reciprocal tariffs higher than those which been for more than a century. Okay. So what it means people were anticipating, the markets was anticipating something which was going on, and then recorded the first quarter of 2025 as the worst quarter for the last 23 years. So that means something was in cooking, and people were anticipating bad news, but the news ended up being worse than expected yesterday. So as you can see, American stocks been worst since 20 for the last 23 years. Okay, so as you can see, the worst quarter for the last 23 years. Let's look at the economic uncertainty index. As you can see, it's been for the last 25 years. The uncertainty was only during pandemic time, which was not a long time ago, but it's never been that uncertain that right now. Okay. Now, let's look at the valuation and compare them with the dot-com bubble. As you can see, this is a dot-com era time, and this is the price per earning. So there was a jump in 2025, and then we're pretty close and already started adjusting. But if you look at the price to sale ratio, that we're all the way above the dot-com era, okay, which is a really bad news, okay? And interestingly enough, about a month ago, I presented that chart during my webcast here, and also compared different type of bubbles. So was it 1929, 1968, 1999? That was a internet or dot-com bubble. And as you can see here, we can call it an AI bubble, which started bursting right now. And let's analyze what's going to happen next, and let's do technical analysis as I promised. Okay. So as you can see, we can look at the RSI relative strength index, which is really oversold and been oversold even before the April 2nd or April 3rd of 2025. And as you can see, the value is somewhat similar, which was during the pandemic time. okay? So the both points of RSI somewhat equal. And then the question is that the time to buy or not to buy? And that's what we're going to be exploring in this presentation in more details, okay? So let's look at the typical moving averages for investors. It's 200 days simple moving average, 150 days, and 100 days simple moving average. And as you can see, it even before April 2nd, the first quarter crossed all moving averages and then really targeting the direction down, okay? As you can see, it's been very rare when all moving average has been crossed, and in most cases it was touching, and the last 2 years being exceptional for the stock market, and now we have to reconsider the way we approach in the analysis, okay? Now, let's talk about the chances of recession and what are the ways to look at that and how people are trying to predict recessions. They look at two different types of charts. And one is 10-year treasury yields. So as you can see, it's about right now 4.5. And before I was preparing this presentation, the consensus was everything is fine because it's not moving down. But if we look at the today's data, then it's actually started moving down. Let's look at the different scenarios on the next slide. And if as long as this is treasury yields in this box, we have stable economic conditions. And if we look at the early 2022, when this interest rate went up, then it's time for the inflation. And a recession, you have to look at the yields going down, okay? So there is a theory which says that government needs to refinance a lot of treasury bonds next year, and the government is going to benefit out of the recession because the interest rate is going to go down. So that means they are trying to force the economy to the recession. And if it is in a recession, then they can refinance quite a lot of treasury bonds, okay? And if you look at the 2008, then that's exactly what was happening. The interest rate was going down, and that was the time for the recession, okay? So it means if the interest and the yields are going to go down, so then we're approaching the recession. If it's going to stay in the box, then there's going to be no recession, and different types of conditions need to be applied, okay? Now, let's look at the employment correlation to the recessions. As you can see, employment is always going down when gray area is recession time, and this is the 2008, then this is internet bubble. So every time it goes down. So we disregard the COVID time. As you can see, these days, there is no indication for the recession yet. So it needs to be observed. And as you can see that the chart of S&P 500 very well correlated to the employment picture. So that means as soon as the employment is going to go down, then the chances for the recession are going to go also very high, and the recession is going to start. Every time there was some corrections, as you can see, these are points of corrections, which did not coincide with the drop in employment. Then there was no recession, and you can easily buy the dip and then keep going. So this time needs to be evaluated with regard to treasury yields and employment. So what people are expecting for the next months, year? The expectations are is going to be kind of going this way. How far down, nobody knows. And maybe it's going to go further down from this point. That's where we are right now. And then it's going to be really good buying opportunities. But when, nobody knows. And the question is where to look for the leading indicators. So let's analyze the following leading indicator, which is new one-family houses for sale. Okay, so I'm going to make a case that in order to find out what's going to happen in the future with the stock market, you have to look at the housing market and the housing construction market. And look at this picture. These are the houses for sale. This is a preview of a great crisis of 2008. And as you can see, it led us to the recession. And this is the number of houses for sale almost equal to this number, which is troublesome. Okay. Why housing market is important? Because if the people are buying and selling houses fast, then they buy TVs, they repair houses, they buy stuff for the garden. So there's a lot of other consumers' participations in the market. Okay, because these days so many houses on the market, we see the delinquencies are going up. So that means people cannot refinance their mortgages and delinquencies go up. Okay. As a result of this amount of houses on the market, the whole building situation index is going all the way down, similar to what happened in the preview of 2008. Okay, so that means if there is no construction, then there is a recession. Okay, it's not guaranteed, but pretty much every time it was going down, down. There were some recessions coming up. Okay, so as you can see, the stocks of home builders, they are going down before S&P goes down pretty much in advance. So that means if you're going to be closely watching home builder stocks, then you're going to anticipate that in the future, the S&P 500 is going to go up, not down. But as long as this keeps going down, then there is no future. Okay. So that means this is the leading indicator. So now let me make a case what's going on with the real stock market and whether or not it is the AI bubble. So if we look at the consolidation of the top 10 companies from S&P 500, then you can see that 37% of the value are concentrated in top 10 versus 24% of concentration of value was during dot-com era. That means this is a huge concentration of power. And if these companies, 10 companies are going to start bursting, then the entire market is going to start bursting. Okay, now let's look from technical analysis perspective and see what's going on with the moving averages. And you can see that technology sector, and that's important to understand, most of these companies are from technology sector, their moving averages already turned down. Okay, and that's an important indicator that the troubles are coming up and the AI bubble started bursting. So what we can see, some people call it the Magnificent Seven, it's already in the correction territory. It lost for the past quarter almost 20% of the value. So how far down is going to go the technology sector after April 2nd, 2025? And that's the real $1 million question. And if we look, then it is kind of in this territory. How far down it's going to go, nobody knows, but we have to watch and see for what? For home builders, we have to watch for the treasury yields, and we have to watch for uncertainty and how the things are going to be unwinding with the tariffs. Okay, but important to understand that there will be a buying investing opportunity sometime later, but at the meantime, the market is going to go down or sideways. Okay, so the next topic which I wanted to cover was, and that was announced in our webcast. This is the how to use inverse ETFs with AI trading agents. And that's going to be the next topic. And what I'm going to do, I'm going to stop recording and I'm going to start another one where I'm going to make a case trading versus investing.